traders and friends, market participants and enthusiasts right around the world. Thanks a lot for joining me on this Monday afternoon market recap. Quite an interesting session to begin this week's worth of trade across the board. The US financial markets have been under significant pressure during Monday's session of trade. The Dow Jones Industrial Average closing down just shy of 460 points. The S&P 500 again closing down very close to 60 points, and that of the NASDAQ, to round things out, closing down very close to 200 points. This equates really on aggregate to about 2% down per market. What is good to know, however, is that we are coming back down to retest a series of macro support areas. What we have identified since establishing the low in February across the board for the US financial market indices is a general vicinity or target as to where the market should come on back down and retest. Now, as it stands, we are beginning to close below those February lows, or at least for the Dow Jones Industrial Average and the S&P 500. You can see on my screen again, we're flirting on the edge of what appears to be a cliff. You can see the S&P 500 again getting very close to that February low. We did intraday push below this particular candlestick over here. But the reason for this recording, or at least this Monday afternoon market recap, is just to update you on X marks the spot. And generally, you'll hear me talk about this phrase, or at least reference X marks the spot. And really what I'm referring to is multiple areas of support. So what should come as a comfort for those of you who look at the markets a little bit more closely rather than others, or what the general majority do, is that if you pay attention and follow along to the 200 simple day moving average, you can see across the board that we are coming back down and retesting this critical area of support. You can see actually that there was a little bit, of intraday buying towards the end of the session. Across the board, the markets did push off from those intraday lows, and this is in respect and in observance really of this rising simple 200-day moving average. You can see it's coming in at 2,589 points on my screen. The S&P 500 closed slightly below that, only 8 points below that. But above all else at the moment is that you need to, of course, expect volatility to continue around this critical pivot. And this is essentially the moment of truth for the US financial market indices. As long as we roughly hold above 2,525 on the S&P 500, for the Dow Jones Industrial Average, it's anywhere above roughly 23,000. You can expect, of course, these markets to ultimately stabilize and then inevitably turn and push on back up to close this open window. It may not play out this particular week. It may be a series of weeks upon which this pattern is going to play out. But the good news at this particular time is that during the session and the intraday movements today, as at Monday, we are coming back down and we are starting to see, of course, a reaction off from this general area of buying support. You can see again the intraday movements. We pushed on down intraday below that rising 200 simple moving average, and buyers began to show back on up. You can see that's why we have this long lower wick below, of course, today's candlestick. You can see the 200 is coming in at 23,424. We closed today, however, a little bit higher, unlike the S&P 500, 23,644. So again, although, of course, at least the momentum during today's session was quite heavily to the downside, it was a little bit of a bloodbath there across the equity markets. The good news is that we are once again drilling back on into that macro support, and we're assuming that over the space of the next 1 to 2 months, okay, at some point we are going to get that definitive turn on back up, and it is ultimately going to drive the US financial market indices, especially the Dow and the S&P 500, to come on up and close these open windows. I've been speaking about this for quite some time. It's looking really nice at the moment. I know, although the pattern itself, or at least the momentum, is quite bearish, I'm expecting that this is going to change. We've got multiple areas of support holding this market up. And even if we do see a little bit more, I guess, downside potential, at least momentum in the markets, this is really in reference to the NASDAQ. If I can bring up the long-term simple moving averages again, we do have a little bit further until we get that definitive test of this long-term rising 200-day simple moving average. The last time we actually tagged this, you have to go back quite a distance, and this is all the way back to essentially June 2016. So again, this still holds firm as a very healthy correction. I'm not calling this. This is this of the beginning of that of a bear market at the moment. We haven't seen enough structural damage, so to speak. We really need to start cracking below roughly 6,500. But before we get there, we should see ultimately, and that is, of course, if the markets do decide again collectively to move into potentially that of a macro bearish trend. Again, that is pure speculation at this point. Before we can do that, we need to see again these markets rally and establish that first macro lower high, which we haven't done at the current juncture. So again, as at this Monday afternoon, as I bring you this recording, please understand we're still holding at that support area. We've got a multiple, or at least a multiple series of support underpinning this market. And even if we start going into at least the oscillators of these markets, you can see collectively that we are still pushing down into oversold territory. And generally, once we get below this oversold trigger and then cross back up above it, that registers that of a buy signal, and it fits the picture, and at least the story, the narrative very well. Because if you pay attention to this market, it looks as though, especially for the NASDAQ, that we are in some form of a sideways channel. So collectively, or traditionally, I should say, the exponential moving averages, which are the shorter term, exponential moving averages compared to that of the longer term simple moving averages, these go out the window in terms of just traditional buy and sell signals. So you want to be paying attention to the oscillators. What are the oscillators telling you? They're telling you, and it shouldn't come as all that much of a surprise, that the market itself is relatively oversold. And when we do push on down into these oversold areas, we generally see a bounce to take us on back on up to the top of that channel. The same is true for the industrial average. Pay attention to this. You can see the stochastics is very close to registering oversold conditions. The RSI got there last week. It is starting to see that of a bounce and a secondary retest of the support, just like we saw during the period of February 18 in the MACD. It's not really giving us, all that much conviction, so to speak, in its signal at the moment. But pay attention to that, especially if you see, potentially a one white soldier type of candlestick set up at some period during today's session. This session's, week, I should say, or even next week, because that is going to shift, of course, the dynamic of momentum, which is still rather favorably and strongly in control of the bears at this particular point. This is the S&P 500, and again, we are collectively moving back into oversold territory. Also, if I can just throw one more piece of analysis into this, pay attention to these Bollinger Bands. They are separating. We tried to push on outside that lower Bollinger Band during today's session, but we started to see again buyers show back on up, and we're starting to see price action hold within this Bollinger Band. This is not that of a reversal at the moment, but it generally does lead to that of a reversal. The last time we got this type of signal was again back in February, where we started to push with these lower wicks outside that of that lower Bollinger Band. I can bring it up, of course, on the Dow Jones Industrial Average. You got it here in February. We're starting to see it as at today's session on Monday. So this is something that probably isn't going to play out over the next couple of sessions, but pay attention to the support area. Pay attention to these rising simple moving averages, and again, the risk and reward ratios. Okay, if you break it down and you start looking at these potential trades, especially for the SPYs and the diamonds moving forward, they are quite favorable to be opening up potentially some long orientated positions for the actual indices themselves. Whether or not you want to trade the diamonds, if you're an options trader, it's up to you. That's your decision. But the calls at the moment are looking quite enticing. And I'll just share with you personally today, I added a bunch of calls to an original position that I enacted a couple of sessions ago at 24,130. That also reminds me that I can begin to bring down this continuation trigger that was just placed above Tuesday's candlestick of last week. You just saw me, I brought it down to 24,367. This is going to start confirming momentum and potentially a little bit of a slowdown at this gap until ultimately we break out of this sort of defunct type of descending type of triangle, which still appears to be under construction on the industrial average. It was shaping up to be that of a symmetrical triangle until, of course, we broke down below it towards the end of March. So a lot happening, I guess, in the undertones of the market. And it's very important that I update you on, again, the price advancements in terms of candlesticks and the support and resistance and structure of the market moving forward, because, again, the reward risk ratios from these areas, even if the markets do overshoot to the downside, albeit temporarily, are very nice, and it is rather justified if you're starting to, again, sort of focus in on this open gap that we've been focused in on for a number of weeks, if not months, since we started establishing that of the symmetrical triangle. So I think that covers really the market update. We went through in comprehensive detail our top 12 individual trade list. I will recap this most likely tomorrow for you. I'm very interested to see how tomorrow's session plays out, but above all else, just understand what is happening with the financial market indices. I wouldn't be reading all too much into the media, of course. It seems as if the world's going to end almost as at Monday. It has been a tremendously weak period for the market. a lot of people championing that for a larger correction or that of potentially that of a bear market. But before, again, we can move into those types of trading environments, or at least to reverse certain trends, we have to see the technical picture shift. And again, it hasn't really done so. It is still confirming that of a larger sort of intermediate correction. But again, it's looking to end as we push on back down with these oscillators moving into oversold territory. Whenever we get down here, wait for the reversion back on up. And that is what we are very close to establishing as at the close on Monday. If you have any questions, please email me, success@pivotpoint-trading.com. Until next time, everyone, stay safe and be well. I'll be back with you later in the week, most probably actually tomorrow, for another market recap. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. All the best. Farewell.